Hello, this is Leah, and I'm coming to you with a bonus video that I am sharing with all the potential students of FX University who are interested in joining and learning how to trade. In this particular bonus strategy, we have several indicators, and I will explain how to use them, how to place the positions, how to place entries, how to take profit. So basically, but if you are a trader, you're probably familiar with the expression that price is the king. So that's how we trade. We trade based on the price action itself, and these indicators only help us to figure out mathematically where to enter. They help us figure out mathematics of the market, that markets are pretty much have a lot of symmetry in them, and that is our expansions right here, where the trend momentarily bottoms out, where the trend resumes. So we know all of that, right? You also have to understand that the price is important because it's both historic and predictive. We need to understand when we are in the market, we need to understand the price in relation to its own moving average. And that is why one of the important indicators here is the standard Bollinger Bands. So in black, you could see Bollinger Bands. The Bollinger Bands consist of the moving average 20, defaults on moving average 20 itself, and the 2% bands that deviate above and below the MA. Okay, so in this particular template, we use the knowledge that if the price closes back below the moving average, we might have an entry. Another confirmation in blue that we have an entry is the Gann high-low activator, which again is just another modified MA moving average that in an uptrend follows the price as support, and as the price changes, it turns and being resistance. As the trend changes, it becomes resistance. And here you have, on the close of this candle, signal to go short. So you have 1, 2 indicators, and the third one, the price closing back below the MA. You go for 15 pips at a time, dependently on where your next support is. And this will update itself at each rollover session, 5 p.m. Eastern Standard. The pivot level, resistance, support, you won't have to do anything manually. You also, if you notice, you have two so-called painted panels here, and one of them is to identify the time period of high liquidity hours during London session, and the red one is to identify high liquidity hours during New York session. Once London is over, not only can you trade a beginning of the new trend, but you can also trade a breakout on the close of this candle. Your breakout higher probabilities will be on the short side if the price is still below the moving averages. Okay, which is right here. So you would trade the breakout of the low. You would trade then as New York closes, high volatility New York hours close. As long as you stay below the MAs, you would have another trade here. So with this particular template, you have a lot of possibilities. You have a trend resumption after the retracement. You have again trend resumption after the retracement. Between the high liquidity hours, you have the breakout possibilities. You have all of your indicators to help you identify where the next support will be. You also have a couple of oscillators. One of them is called QQE, Quantitative Qualitative Estimator. And in the solid blue line, you have an indicator that is saying here's the bulls. Okay, these are the bulls, and the dotted line represents the bear contract. Okay, Once the bulls coming into town, as I say, become stronger, they cross from underneath back above the dotted line, the bears. So on the close, as the candle closes right here, your cross has to confirm first, all right? And you could start looking for possibilities of going long. However, you need to understand that if we are in a massive long-term trend, you have to be very careful, all right? And just watch out for about 10 to 15 pips next, and close out possibly at next resistance. And that's where our Bollinger Band trading style, which I teach in the room, is also very, very helpful. So you can trade this on the 15-minute. You could also switch and trade the 1 hour, the same fashion, and look at how many trades just within today you could have had. On the 1 hour, this is your initial trade where the trend begins. You would trade a breakout right here, and you would trade another breakout right here. Okay, right here. This is right here. Okay, so this is 1 hour. You can also put it on 4 hour, and then you would have each stripe will represent obviously most liquid 4 hours during London and most liquid 4 hours during New York. So now once this range is over, you can again trade the breakout out of this range. That's the top, and here's the bottom. Okay, now the squeeze break indicator, let me put it back on the 15 minutes. Another oscillator that you have here is called a squeeze break. This is very, very helpful in which respect? You could see something that looks like a MACD histogram, right? In green and in red. When the histogram is in green, all that means is that we have a trend. It doesn't mean that it's a bullish trend or it's a bearish trend. It doesn't matter. All it is showing to you that the trend is present, okay? And when the histogram is in red, it shows you that the market is practically in consolidation, sideways, flat. Consolidation, sideways, flat. Until we get back our liquidity and we start crossing the zero line and turning green, that means liquidity comes back, the trend is back. Okay, now the histogram is crossed from below to above and from above back to below by this dotted line, which is an oscillator that is showing now that we have a trend that represented by the histogram in green. Once the dotted line crosses from above back to below zero, that means there is more bears present and our higher probabilities are on the short side. Here we cross back up, okay? It obviously is following the price. Okay, here we're crossing back up, but our trend now is going down, 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 and we really have practically nothing here, flat market, until we resume, all right? And at this time, you have a oscillator crossing back down the zero. So as your trend resumes and your dotted line below zero, you could start taking short positions. And that's the bonus. If you have any questions, please contact me through the website. Thank you very much.